Debt has become a major issue in the United States, and that's what we need to talk about today. There was a story yesterday about Michael Burry talking about how credit cards are becoming a major issue and being compared to what happened to the housing market back in 2008, 2009. You also have what's going on with mortgage-backed security, and the Fed, now this month, September, they're going to start tightening. So instead of putting money into the economy, they're going to be taking money out of the economy to try to control inflation. At the same time, they're going to be raising interest rates. This also throws off the balance of the repo market, so liquidity is becoming an issue. All of this could be some kind of catastrophe going forward. I'm going to pull up the first story that was sent to me yesterday. This is the first story that I looked at and I said, oh boy, coupled with the story that I did about Michael Burry, maybe we're running into some issues. So the next financial crisis may already be brewing, and it might not be where investors expect. So the Federal Reserve, the QE, is starting to kick in high gear in the next month. So that right there alone, first thing it tells me is, okay, what's going to happen with liquidity? Is liquidity going to be a concern going forward? So the Fed has been buying back mortgage-backed securities, not putting much as stimulus into the economy, but now they're going to be rolling even more off of their balance sheet to try to shrink that $13 trillion balance sheet that they've accumulated over the last 2 years. So declining liquidity and resiliency of the Treasury market arguably poses one of the greatest threats to the global financial stability, potentially worse than the 04 to 07 housing bubble that was created. Now, typically, when you look at the bonds, the 10-year bonds, Treasury yields, wherever you're looking, which are currently sitting at that 3.41%. I talk about this all the time on the morning show. People look at this and say, it's more of a risk-free rate. We don't need to worry about this as much. Why? Because it's backed by the federal government. If there's any type of issue with the federal government, then we have a lot more problem than what type of annualized rate you're going to be getting from Treasury bonds, because that means that there's defaulting going on from the federal government. And we've gotten to a point where people are pretty worried. When I drive to downtown Cleveland, maybe once a month, once every 6 weeks, there's a sign up there on the way downtown, and it says how much debt there is per citizen in the United States. Right now, it's currently sitting at over $93,000 per person in the United States. That's an astronomical number. I'm going to pull up something else here in a second just to show you the ticker of debt. Now, we need to talk, when we talk about liquidity, we need to talk about the repo market. So what exactly is the repo market? So here's what the situation is. You have banks on one side, and banks need to have some type of liquidity overnight. They're sending out tons of money for loans and loans and loans. And if anything happens, they need to be liquid overnight. On the other side, you had hedge funds. This is what it used to be. This is what it should be. Hedge funds. These guys need to have liquidity overnight. Where are they getting the money from? Well, hedge funds were saying, hey, we'll loan you money overnight. Just send it back in the morning. And when you send it back in the morning, send it back with a little bit of interest. Throw in there an extra 5 basis points, call it. So they would send over however many billions of dollars overnight to keep them liquid, and they would return it the next day at 0.05%, maybe call it 2%, whatever it was, whatever the repo rate got to. There was some incentive for the hedge funds to give the money banks liquidity overnight. But what happened? Our interest rates got so low from the Fed funds rate when they took it to 0, these banks were not paying anything. So they were paying 0%. Well, what incentive is there for the hedge fund to send money to a bank overnight and risk some type of issue that by the morning? Well, there's not a lot of it. So what happened? The hedge funds, they said, screw it. We're not giving money to the banks overnight. So who's going to give money to the banks overnight for 0% rate? Well, that's where the Fed comes in. And the Fed came in and played daddy to the situation. And for $0, they would send the banks billions of dollars overnight. And this is where the repo rate got out of control. This should not be the system. The Fed should not be stimulating repo, because this is all hedging on printed money. And that is the problem that we were getting into with the repo market. So all of this liquidity, yes, there was technically liquidity there, but it wasn't true liquidity. It was not artificially made. It was created money that they were sending overnight. And that is a big problem. Now that they're taking money out of these markets, who's going to, they're still the ones that are paying these repos overnight. And they're saying, okay, well, if they're not going to be having as much money in the system, how are these banks going to stay liquid overnight? And that's where the questions of liquidity come into the issue, because the hedge funds are still not comfortable putting the money over there. And now I don't know exactly what the repo number is, but it is astronomical. And during COVID, it was absolutely astronomical. That is one piece of the puzzle. Let's go to the next piece of the puzzle. Michael Burry. So Michael Burry, famed investor, famed from the movie The Big Short. He was talking about what he did back in the day is he was betting collateralized debt obligations. And he was saying that these obligations are loans and mortgages and other assets that the investment banks package to offer to institutional investors. And it got to the point where there was way too much debt out there to people that could not pay off their loans. He bet on the implosion of the subprime market, that they were just making new financial instruments and putting them in a different area and selling them as bonds. And this is what happened. And this is the big housing collapse. So it was clear that lenders had lost it, constantly degrading their own standards to grow the volume of loans. And now what he's seeing is specifically with Goldman Sachs. Goldman Sachs is taking loss rate in the credit card consumer lending business that was the highest amongst U.S. issuers. Goldman's loss rate in the credit card loans hit 2.93% in the second quarter. That's the worst among big U.S. credit card issuers and well above subprime lenders when you compare them. So what does that mean? That means that personal debt is getting out of hand. They are giving money to people with FICO scores under 660, which are considered high-risk lendees, and now they're coming out with this Apple credit card. Let's scroll down here. Goldman Sachs Apple credit card, more than a quarter to subprime borrowers. 3% of the loss rate was in Q2. Where was that big number from? Goldman Sachs has granted approximately $3.35 billion of the $11.84 billion in consumer credit card loans to individuals with FICO scores under 660. Then you come over to this story. I think we read this one on the morning show. Next piece of the puzzle. Americans keep running up credit card debt even as interest rates climb. So revolving consumer credit card rose at an annual rate of 11.6% in July, according to a report last week from the Federal Reserve. Almost $1.13 trillion in outstanding debt. And that's just on credit cards. This doesn't include anything else. And now it's about to get more expensive. Why? Because interest rates are going higher. We're talking about pricing in a 100 basis point increase at the September 21st meeting. Worst case scenario, they go 75 basis points. That's going to take these interest rates even higher on credit cards. And the fact that you're giving them to these subprime borrowers with FICO scores of 660 or less, there's not a very high probability that you're going to be paying these off in any due time. Credit card balances have increased $46 billion in the second quarter, according to the Federal Reserve, a 5.5% increase, 13% year over year, and that is the biggest gain in 20 years. So Americans have opened up 233 million new credit cards in the second quarter, the most since 2008. So all of this pieced together, let me divert here. All of this news that we have out there, and the majority of people are still spending on debt. They tell us that spending is still strong. Consumer spending is still strong. Well, of course it's still strong because people are taking out astronomical amounts of debt. These are the things that you need to understand and look for and say, maybe I need to think about this just a little bit differently. Yes, they're spending, but is it legitimate spending? Is it good spending? Is it spending that can be backed by something? 2 in 5 Americans expect to pile on debt between now and the end of the year. The bulk of that will be racked up on credit cards, 22%. 3 in 5, 61% of Americans are already grappling with debt. Credit cards being the biggest culprit, 75%, and those are going towards necessities, emergencies, health, and other medical issues. So all of that being said, guys, we are in a situation where no nation has ever dealt with this level of debt, and the number keeps going higher. You look at the CHIP Act that happened. You look at the Inflation Act that happened. You look at all of these bills that they're passing in Congress, and the debt just keeps going higher, coupled with telling consumers that it's okay to keep borrowing against God knows what you're borrowing against. Mortgages, you still have your mortgages, you still have your car payments, you still have health insurance, you have all of these things that are piling on top. So the question of, is the next financial crisis somewhere we're not looking? Yeah, it's very possible. It's very possible. These are just facts that I'm pointing out to you from these stories. I'm not making any of this up. You need to understand it. You need to pay attention and just see all of the behind the scenes stuff. Go to YouTube and go to the search bar and type in repo market WSJ, Wall Street Journal. There is a video on there. It's about 5 minutes long, and it perfectly explains to you what the repo market is. Then you can be that person that understands it and tells your friends, tells your family, and more people just gain the knowledge from there. Guys, my name is Mo. I'm a value investor, and I'm a person that really likes to get into processes and see what drives markets and what drives economies, and that is exactly this. If you want more videos like this, click this video right here. Go watch more of them and understand what's going to happen in our future. Catch you on the flippity flop.